Hello, everyone. My name is Tyler Sanchez, and I'm a financial planner and research analyst for the Rice Partnership in our California office. I'm joined by portfolio manager and senior strategist, Steve Schoenfeld, who also sits in our California office. Thanks for joining, Steve.
Hey Tyler, good to see you. Hope everybody's doing well.
Great. Yeah. We're going to have a conversation today about recent market volatility and what the past can tell us about periods of volatility. Generally speaking, stock market volatility refers to the rapid and significant price fluctuations of stocks over a short period of time. It often reflects uncertainty in the market driven by factors such as economic news, company performance, or global events. When the stock market extends gains quickly, investors are usually filled with bliss, while dystopia takes over rather quickly as soon as the market gives up those same gains. The scale at which markets sell off determines whether we are in a correction or a bear market. Steve, could you expand a little more on the difference between those two?
Yeah, sure. Actually, we've seen some volatility as of late in the markets, and we are in what we'd call a corrective phase. And so a correction, on average, is going to see a drawdown, a decrease from top to bottom of about 13%. And it's going to happen on average in around a 3 to 4 month period of time. Certainly, some corrections can be shorter or longer in duration, some can be a bit more or less, but that 13% average and 3 to 4 month period is typically what you're looking at for a correction. Whereas a bear market is going to be more protracted, a longer term event that we're going to see. The drawdown from top to bottom of the typical average bear market is about 36%. And from a duration standpoint is again much longer, on average around 400 days. So we're talking about a year plus, not just simply a few weeks or months, as a correction can be a bit more short term.
We have many clients asking us now, what's causing this correction? And I think it goes back to those drivers I mentioned earlier, global events and economic news. Right now, we're waiting and currently it looks like there's a trade war on the horizon. The biggest problem with a potential trade war and tariffs is the uncertainty. If executives have clear, definitive tariffs to deal with and time to deal with those tariffs, then they can appropriately reshape their strategy. The back and forth flip-flopping leaves companies grasping at straws to an actual impact on their business. And this could fuel volatility and potentially affect their earnings in the future. Another important part of market volatility is sentiment. What role does investor psychology play in amplifying market volatility, Steve?
Yeah, Tyler, you mentioned it can amplify the results in the market. It absolutely does when you see investors sort of going in the same direction as one another. And as far as sentiment goes, there's a lot of statistics that come out, some on a monthly, some on a quarterly basis. At the end of the day, it really speaks to how are uh, individuals feeling. Are they feeling more positive or less positive about the current situation in the economy? Do they feel the future is looking brighter? And because it plays into spending. And so if you think about big ticket items like buying a house, filling up that house with appliances and furniture, a big ticket item like a car, individuals are only going to feel comfortable and confident in spending that money if they feel good, more positive about the economy and the prospects for the economy moving forward. Warren Buffett likes to say, has said, be fearful when others are greedy and greedy when others are fearful. And easier said than done to try to take emotions out of the equation. But that's where having a plan in place can pay off. Tyler, what would you say we try to do here at the Rice Partnership to take advantage of when volatility does come into play?
Yeah, so market corrections are generally good things. It gives a slight reprieve to overvalued asset classes, which create buying opportunities. It cleanses the more speculative assets and is usually a sign of market health and an overall readjustment, sort of a reality check for investors. What's most important, though, is remaining invested through these times of volatility. And we here at Rice remain prudent in our investment selection and deliberate if and when we need to make adjustments to our portfolio. So we appreciate you joining and thank you for your time.